Okay. Welcome, everybody. Again, thanks for joining this Perspectives Live conversation. Really excited to get this going as we kick off the year, riding the banking regulatory and policy waves into 2026. Um, Happy New Year to everybody. Hope you all had a great New Year and excited to accomplish great things this year. Excited to welcome our guests. We have Kim and Leanne here joining us, so excited to have them here. What I'll do is I wanted to kick off just quickly introducing them, and then we will dive right into our conversation. But Kim Ford, SVP and Head of Government Relations at Fiserv. She oversees the company's policy strategy and political advocacy engagement in not only the United States, but the EU and the UK as well. Kim joined Fiserv from the US Faster Payments Council. Prior to the Faster Payments Council, she was at First Data for 15 years, managing as a manager of public policy. She was also regional director for U.S. Senator Bill Nelson of Florida, and worked in lobbying and communications roles for several Florida-based business trade associations before that. So welcome, Kim. Excited to have you here. Leanne Lange, managing director of our banking and payments practice here at SRM. Leanne brings over 25 years of extensive experience in consumer deposits and payments and product management. Prior to joining SRM, she was at M&T Bank, specializing in debit card and ATM portfolio products, spanning a broad range of vendor relationships, innovation in emerging payments, strategies for consumer checking and growth deposits, and participated in 17 successful bank acquisitions and conversions. It's pretty impressive. So excited to have her on the call as well. So let's dive in really quick. Well, actually, just some housekeeping items. The chat is open. Again, this is open kind of fireside chat conversation. We don't want this to be just us talking at people, but if you all attendees have questions, feel free to throw those in the chat, and we'd be happy to bring them up with Kim and Leanne. But just wanted to kind of start out really quickly as we look, Kim and Leanne is about a full year into this administration, and we can definitely say we're kind of seeing a stance towards deregulation. Although there's a couple things that have happened recently, we may want to revise that a bit. But what do you see as some of the kind of the biggest implications for the openness, if you will, from this administration?
Steve, thank you for the introduction. And Leanne, always good to see you. So, yeah, deregulation, I think is something that certainly when the Trump administration, this Trump 2.0, if you want to call it that, started last year, I think there were a lot of folks in financial services and certainly actual banks and credit unions who heard this term deregulation and thought, okay, this is maybe going to bring us a little bit of a relief from what was a really active regulatory environment,
Yeah.
particularly under the Biden administration in the previous years. And so, I think it was initially met with some open arms, if you will. And I would say the way that we're seeing that most play out is that as you look at the changes in the leaders at the banking regulators, and I'm specifically calling the banking regulators out, not just the credit union side with NCUA, but you look at the changes at FDIC and OCC in particular, we're seeing this deregulatory stance play out, I would say, mainly in the supervisory space, where these agencies have put out guidance and I think directives to the folks in the field to say, hey, this kind of like death by supervision that we hear financial institutions complain about a lot, of how intense these exams have gotten year after year, month after month. They really, I think the agency leaders are sending a message to say, we really want to get back to pure safety and soundness, and not what we were seeing kind of trending, which was policy making through supervision. So I think we're seeing most of this deregulation on the supervisory side. We've seen some changes in the manuals saying that reputational risk is no longer going to be considered. But I don't think we're quite there on actual pullback of all laws and regulations. And we'll
Sure.
obviously be talking more about that.
Yep. Yeah. Yeah, no, it's interesting that we saw some of this regulatory simplification. But at the end of the last year, we saw, like the OCC sending out a request for information around community banks about their relationships with their core processors and other third-party tech vendors. And so, a lot of, consolidation obviously happening on that side. What do you think the regulators are kind of looking for with that kind of request for information and openness there?
Yeah, so Fiserv, obviously, we believe we are one of the subjects of that request for information since we are a core provider. It does say they want comments from community banks on their core provider and other significant third-party service providers. So that could be, some of
Yeah,
the cloud service providers and others like that. But figure, yeah, core and fintechs are squarely in that bucket. And I think, this. This this idea of asking for community banks to share their experiences about core is not new to the Trump administration. Michael Hsu, who was the acting comptroller at OCC under the Biden administration, and then even officials under Trump 1, had started some of these conversations. We were in different meetings with other core providers in the OCC. So this isn't new, but I think, Steve, again, it's reflective of this idea that that relates to this deregulatory idea, which is the Trump administration wants to make sure that the economy is strong, and they're going about that with all sorts of different policies in all sorts of different sectors. And I think for banking specifically, the idea is, what can we do to make the regulatory burden easier on community banks specifically? And because the community banks rely so heavily on their core provider for not just your basic ledger
right.
traditional account processing, but obviously
Yep.
all the surrounds that we all have adapted to provide over the years. They understand, the OCC knows, they regulate us. I mean, we're a significant service provider. We're subject to these supervisory exams. So these regulators know the critical role that we play. And I think the narrative in some cases has been, hey, is the core a choke point for innovation or ability to serve, let's say, rural customers and so on? Fiserv would vehemently argue not, but it's a responsible thing for the regulators, knowing the role that we play in this space, to want to take a look at this
Yeah.
and ask about the experience and figure out, are there pain points that might need to be subject to some sort of regulation or guidance, or at least let us understand, who those players are, and are we asking the right questions of both sides to make sure that, the community bank segment in particular is able to grow and thrive. I think
Yeah.
that's really what it's really about.
Leanne, we
Yeah,
talk about that all the time here of the community bank being like the lifeblood of the economy and ensuring that they have that opportunity to serve that community and provide those products and services.
yeah, absolutely. And one of the top things that kind of came to my mind when you brought up, how are community banks thinking about this? What can they do? One of the things that we're seeing a lot of, and we're hearing feedback on, is that the regulators are looking really favorably upon those community financial institutions who are going through a process of truly evaluating their core and other bank processing providers against others in the marketplace. Some are leveraging, SRM sourcing practice to do that, and we're helping them through that evaluation process. Of course, some decide they want to go it alone and do it themselves, but the regulators themselves, when they're coming in and performing audits, are really looking favorably upon that kind of thing. And it is critical, right, for community financial institutions to be able to be up and running near 24/7. I think we all know about the Verizon outage yesterday. That wasn't so good. Impacted me, but when it impacts a bank or a credit union and their customers and members, that's impacting their daily lives. So, anyways, core processing is definitely an important topic.
Yeah. Um, Probably one of the most impactful things we saw from the administration when they came out was the move to defund, dismantle the CFPB. There's been a lot of legal back and forth on this. where does the agency stand today, Kim, and kind of what's the latest there?
I was wondering when you said most impactful, there are like 30 things I feel like now
True,
to
true.
choose from. So, my goodness, it's been a really active
Yes,
past year. But yes, talking about the CFPB, and I know we've got some other topics to cover just from this week. But on the CFPB specifically, I think, I mean, look, we all know the CFPB has been a political hot potato since the day it opened in, 2011, right? I mean, it was created in the Dodd-Frank Act that was passed in 2010. Remember that when the Dodd-Frank Act was passed, it was a fully Democratic House and Senate and a Democrat in the White House. So ever since then, there have been Republican sort of objections about some of the things that have played out in the Dodd-Frank Act. And there have been fights over the years about the CFPB, about the structure, being a one-person director instead of a commission, about the funding, right? But I think, what we've seen is that um, every time there's a change in the political party in the White House, the CFPB becomes a very different animal, right? And so we saw certainly under President Obama and President Biden's tenures, the CFPB was very active in rulemaking, guidance writing, enforcement actions. And then conversely, when there have been Republicans in the White House, the CFPB has taken a little, not that they've done nothing, but they've taken a little bit more of, an
right.
arm's length approach to the industry. So we kind of, I think, in the beginning of this Trump 2.0, we kind of thought maybe it would be like the past time that President Trump was in office, and you'd have a fairly active CFPB, but nothing like kind of what we saw under the Biden years. And instead, the acting director, Russ Vought, who's also head of the Office of Management and Budget, has really taken the position that he wanted to try to dismantle the CFPB, and he made that very clear. But there are limitations of what the administration can do because it was a Congress authorized and created agency in the Dodd-Frank Act. And so that limits what the White House can do to actually dismantle the agency. So we saw some really, I think, kind of creative approaches where, first they tried to essentially fire most of the staff. That process has been put on hold, although there have been still pretty significant reductions. I think at its peak, CFPB had about 1,700 staff. I think they're down to around 1,000. That could even be reduced depending on the outcome of the court case. So you've got much fewer staff working on issues. They're not actually going into the building. The building has, I think, been like locked. The sign's not there in DC.
Mhm.
So you've got kind of staff that's now spread out. And then the latest effort, I would say, in the last couple months of 2025 was that Russ Vought, the acting director, said basically the funding source for the CFPB, which is supposed to be combined earnings from the Fed, so read that as profit from the Fed. They said, and the DOJ was aligned with this, that there have been no real profits from the Fed, and so therefore there was no money to
Mm,
provide to the CFPB. That also became subject to a court action. And so just, I think it was like Christmas Eve, right at the end of December
Mhm.
of last year, the judge said, not really buying that argument that there aren't combined earnings and that the CFPB is required to request funding. And so it looks like the latest is instead of the administration or Russ Vought trying to fight that decision, the CFPB leadership actually did just make a funding request. It's about a third of the amount that we saw under the Biden years under Rohit Chopra, but it's about 145 million. So now I would say, sorry for the long-winded answer, but I think it's important
no,
to kind of know these
yeah.
like
Mhm.
starts and stops.
Context is
So
key. Yep.
yes, so now we're at a point where CFPB has requested funding. So we should assume from that they are operational. That means they are going to be engaging in rule writing on various topics. But it does appear that I don't know that they're calling a bunch of staff back. And so I
Mm,
think that no matter what, they are going
yep.
to be doing their work with some reduced levels of staffing, which also impacts the supervisory space and how many
Right.
exams will be made. And then also things like enforcement actions that could take place.
Great. I
Uh,
mean, so along those lines, I mean, oh, sorry, Leanne, you.
I was just going to say, talk about riding the banking regulatory wave. we really felt last year like it was almost, refreshing in the financial services space to have a little bit of deregulation relief, but it really feels like it's kind of coming back now, a little unexpectedly. I mean, I think everyone maybe expected the CFPB to get some funding. And, one question I have for Kim on the CFPB funding, it seems like it's sort of just a request for temporary funding that just gets them through maybe a certain period of time. Is it, 2026 that we're looking at, we think?
Yes, Leanne, I think the fact that it is lower by quite a few tens of millions of dollars than the past, you could extrapolate that to say, okay, right, does that mean that like it's funded till June?
Yeah.
I haven't looked, I don't know exactly what they're using as the rationale for that particular number, but I do think that having the fewer staff doesn't necessarily mean that things would cease like in June. It could get them through the year, let's say, but again, at a much just reduced amount of people to
Yeah.
do the work, which then again does mean reduced output. I will say though, in the past, I mean, the way that that funding is structured, there was a certain percentage amount that the CFPB could request. And in the past, those directors just requested the full amount. That didn't necessarily mean they needed the full amount to operate. But the
Right.
one big beautiful bill that passed last year also lowered that percentage. So
Mm.
no matter what, the CFPB was going to have to figure out how to operate at a lower amount of money. Anyway, I think it was like from 12%
Yeah.
to something like 8%. But that doesn't necessarily mean it's only going to get them through 6 months.
Yeah. I mean, one thing that I thought of, and Steve, I think this is where you're going, so I'm really sorry. I might be stealing your thunder here.
You're correct.
But, you know, just thinking about where the CFPB kind of left off, it feels like it left off a lot with the open banking 1033. And I told you I was going to steal your thunder, Steve. Sorry. um, you know, so a lot of financial institutions are still thinking about open banking. Do you think the CFPB requested that funding so that they could kind of expedite some of the finalization of proposed rulemaking around that? And like, what does that look like? And when is it coming? Not
I
that you
think,
have the crystal
yeah.
ball, but just
No,
some thoughts.
no, it's what we're here for, right? I think that the CFPB requested the funding because the court made them do that. I wouldn't necessarily tie it to because of 1033. Now, it does enable them now to, I think, take a little bit more of a, maybe you could call it measured approach, take some more time in the rulemaking. When they hadn't requested the funding, they predicted they would be basically ceasing operations by the end of January. Now they've got funding. Okay, you have time to do some of the things on the agenda, but I do think it was really court driven. But again, kind of the benefits of that, if you want to call it the benefits, is now they are gonna, I think, go a little deeper on the rulemaking. And so for 1033 in particular, the last that we had seen, and this was based on court filings, because again, that rule had been challenged the day that it was finalized in October of 2024. The CFPB initially said they were going to revise the rule, and because of this kind of limited runway of time, they were going to put out what they called an interim final rule, which would have been, okay, here's the final, it's going to have an effective date, and it would have been maybe, I think, some fairly substantial changes from the past final rule. Now it's our understanding that because of the additional time, the CFPB is going to go ahead and move to a proposed rule. So we'll see some probably fairly material changes from what the rule was, but then that will include a notice, a comment period, could be 60 days, could be 90 days, and then a final rule will come out after the industry has time to comment. So we are seeing that 1033 process lengthen a little bit, Leanne and Steve. And there are some really meaty things that the CFPB is considering and has to decide, in the proposal and then the final. And one of those, for instance, is who is a representative of the consumer? If we're talking
Mhm.
about open banking and I'm the customer of the bank and I now want to share that information about me and my checking account with a third party, do I need to make that request directly through some sort of portal? Or is it okay for a data aggregator to do that on my behalf? As
Right.
we all know, open banking has been working through data aggregators, right?
Yep.
One to many, it's efficient, right? We all know the big names there. But if that changes, that could also change their economic model.
Hmm.
How do you
And the user experience from that perspective is,
exactly,
yeah, right?
right? And
I have to
verifying the
then, anytime I
consumer.
want to do something, I have to give permission multiple times. Yeah. So it
Right,
friction
right.
and delays it. Yeah. The like.
Yeah, so who is that person that is able to make that request very much matters. But then also the pricing around that. So we know there was an effort by at least one large bank last year to essentially say to data aggregators, hey, we're
Yeah.
going to start charging you when you want to make these API calls to our systems. Um, the CFPB now has to determine, do they want to write a rule that addresses fees, and if so, how will they address fees? And I think, looking at this administration, and again, kind of looking at Republican sort of ideology and conservative ideology, I don't think this administration would be interested in basically restricting fees. So I think, I could see this rule allowing for some reasonable level of fees. And then, of course, there are bigger other considerations around privacy and consent.
Yeah, I mean, I can jump in here a little. I mean, I think where Kim was going is that, yes, there are a lot of items still for the CFPB to consider when it comes to open banking. But, I think even though there's, I know a lot of the banks and credit unions that are out there listening to this today are thinking, okay, but what does this mean for me? What should I be doing? And, a lot of what we're seeing and helping financial institutions through is thinking about, hey, continuing down the road of open banking, even with uncertainty in the very short term. Um, you know, we're moving forward with it. Banks are moving forward with it in very different ways. You've got some banks that are trying to go direct to some of the fintechs through APIs. You have others that are trying to leverage third parties, many that are leveraging third parties, even some of the very largest financial institutions like Plaid and Finicity, et cetera, to help enable open banking capabilities and sharing of consumer information in a really safe way. And, we're seeing financial institutions ask questions like, how should I be thinking about open banking? Should I be leveraging it to develop new, value propositions for our customers or members? And what are some of the providers that we should be thinking about if we're going to embark on open banking right now? So those are a lot of the conversations we have with financial institutions now. Just, what should our strategy be? How does it relate to our payment strategy? And how does it relate to our tax strategy?
And
So
Leanne,
I'll
I
just,
think, there's obviously, like you just, so there's the regulatory side, that's what I think
yeah,
about. Then there's the business side, that's what you were just talking about. And I think, on the regulatory side, it's great if there are efforts to, make it more palatable for all of the users of the system, the data aggregators, the data providers, the consumers, the third parties, et cetera. But I do think that if you look at, I mean, lots of larger institutions had already rolled out
that's right.
pretty great open banking systems with disclosures
Mm-hmm.
and such and such. And so I would hate to see it become this like huge competitive disadvantage for smaller
Absolutely.
institutions, because a consumer who has tasted the like frictionless or convenience of open banking generally likes it. And so that's why I think even with the rule maybe in flux, and we will ultimately have a final, I do not think open banking is dead. I think it's here to
Yeah.
stay. And I think that community banks should be thinking about ways that they can, make that option available in as cost effective of a manner as possible.
Yeah. Yeah. And I mean, interestingly enough, and I know we're going to, kind of get to this a little bit later, but, I don't know about you, but it wasn't really, I mean, it was kind of shocking, I guess, when JP Morgan Chase came out and said, hey, we're going to start charging um, some of these third party providers doing API calls out to us for that service. Immediately as someone in the payments industry for years, my head went to, oh my gosh, this is the new interchange. Whoa. Have you thought about it that way? Like, I mean, we're guessing here, we're having an informal chit chat, but like, if the CFPB and the current administration are maybe not going to touch the fee side of open banking, could that be the case?
I Look, I think, there are plenty of data providers or financial institutions under the rule who say, okay, under the former final rule, like you're asking me to do all this setup, have these fast responses, great uptime, and like I can't recover my costs. That feels unfair. And I think, again, this administration is very sympathetic to those arguments. Not great for a data aggregator who's built an entire model not thinking about fees. So I do think, Leanne, that the fees could be a part of this moving forward, and it's going to require a lot of negotiation between aggregators and especially the large issuers who are going to have the most API calls. And what that does to the consumer experience, hard to believe most FIs would want to pass a fee down to their consumer. But with that said, and I get laughed out of the room when I say this, but like think about what we've seen in faster payments, where if I do, let's say, a remote deposit check and it says, okay, you can either have your money in 2 days or you can pay this fee and have it now. I don't think it's out of the realm of possibility that some of that could bleed over into open banking of, okay, if you want to get this done quickly, here's your 25-cent charge. I could be completely wrong. I know that's a lot of FIs don't want to introduce new fees, but if all of a sudden a rule allows it and you see fees proliferate, that might be something that has to be considered.
Well, I
Yeah.
mean, you walk into UPS or you walk into the Postal Service, and you're like, hey, I don't care whether it goes by ship or boat or train or car, but I need it there at this date, and I'm willing to pay for that speed. And so it's not a foreign concept, if you will, from a consumer experience perspective. Yes, I mean money is different, but at the same time, it's a lot of times more valuable than that package that you're sending. And depending on the need, yeah, I need this now. I need to pay my rent. I need to pay this. I need to put a down payment on something. And I need that today. And so, okay, yeah, I'll pay for that convenience. Or I need the data. I need access to this application to be able to push that through. And so, yeah, I can definitely see that from a user experience perspective of that coming into that user experience.
Yeah, I do think that most financial institutions are looking at open banking as opportunity to create the frictionless experience, right? And not introduce fees direct to a consumer or member, but more so to the third parties who are charging them, right? The third parties like Plaid, Infinicity, MX, et cetera, right? They're charging fees to banks just to implement the service. So shouldn't some of the financial institutions think about how they recoup some of those costs from
Yeah.
the third parties and not from the consumer? But anyway.
Yeah. Well, so let's kind of segue this fee conversation into the never-ending debate on interchange and swipe fees, if you will. and kind of the truth bomb, if you will, that President Trump laid on people around the 10% cap on swipe fees. I imagine that's created a buzz. Kim, you had mentioned that you were like, all right, let's get all of our clients on a call and talk through this. And what feasibility of this, if you will, and kind of impact here.
So yeah, so the Truth Social post, which was last Friday night, January 9th, was actually not about swipe fees initially. It was initially about a 10% rate cap on interest
Interest.
for credit cards.
Sure.
And unclear if that's consumer and commercial or what, but President Trump said in his tweet he wanted a year cap starting on January 20th. There is no law that requires that, though. And while the president obviously has a lot of authority in a lot of areas, you can't, pass something like this by social media post. So, all eyes are now on whether Congress will try to pass some sort of interest rate cap, either temporarily or longer term, or if President Trump might try to accomplish this through an executive order. That is a tool available to him, but that has limitations as well. Or if you might see one of the banking agencies. In the past, you would have seen probably the CFPB take this on.
Yep.
But interestingly, the Dodd-Frank Act prohibits the CFPB from setting any kind of usury cap on extensions of consumer credit. So this is off the table for a CFPB reg. And so certainly I think, there are with anytime the president puts his support behind something, you will have some Republicans who then say, well, then I support this. And so we should expect that for this 10% rate cap. However, that doesn't mean the entire Republican base in Congress supports this. And we're seeing this huge influx from the banking lobby, credit unions, the payments trades. They're all talking to Congress this week and saying, look, if this type of rate cap were to go through, we would see a serious pullback on credit availability,
Yeah.
and
Yep.
it would
That's
backfire.
that is the biggest
Mhm.
implication there of just
Yeah.
you are then taking away the availability of a huge segment of consumers and businesses to be able to
Yeah.
have access to credit. And yeah.
Yeah. I mean, what I can't figure out, Kim, I guess, is, where do we think he's going with this? I mean, that might be an unreasonable question to ask, but last year I was calling this, sort of the administration of, anti-price fixing as an example, where they were kind of peeling back, in my view, on things like Reg II and Durbin related fee caps, or fee caps, let's say, on overdrafts. There was softening of that. So I thought we were maybe kind of stepping back from that environment of kind of price fixing. And then this 10% sort of, not even buzz, but like bomb got dropped. Like, where is it coming from? Is it, is it something that some larger banks have done? Like, what do you think is driving it?
Yeah, and that's, interesting that we started with deregulation. That is not an example of
Yep.
deregulation. That
Right.
is serious government
Right.
regulation in the private
Yes.
and the free market. So it is, I think, again, confusing for some who you look at traditional Republican ideology, and that's that's not part of it. So it is a head scratcher for some. I think, Leanne, what it's really about is we're now in a midterm election year, right? Midterms happen in November. If you look at historical data and trends, the party that's in the White House suffers usually in Congress. And so I think as President Trump, member of the Republican Party, is thinking about November, nervousness about losing the House majority. I think the Senate will probably stay in Republican control, but with a divided Congress, much harder to get your agenda passed. There is talk of potentially impeachment efforts again. And so I think he's trying to listen to what his advisors have been telling him for the past few months, which is affordability matters. We saw that play out in the New York mayoral race. And so I think what you're seeing is just this almost like throwing spaghetti at the fridge to say, okay, how do we get prices down? And so, finding things that sound on its face, hey, my credit card bill could be lowered. That sounds on its face really good until you start going through the mechanics of how banking and credit work, and you realize that it would not actually help most Americans. But yeah, I think it's really all about this, like finding ways to kind of promote this affordability agenda.
That makes a lot of sense. But to your point, I think we all saw what happened with, Durbin 1.0, and no one saw any price reductions. I don't think at the point of sale, when debit interchange, for example, was cut by more than half, right? And now to have credit card interchange kind of capped at 10, wow, that's a huge impact to financial institutions, their card portfolio profitability, their ability to offer credit, right, to consumers. So that's going to be really impactful. It's going to be interesting to watch that play out.
Yeah, and again, just that's still interest rate caps, not interchange caps, but it is related in the sense that I think a day or two after President Trump tweeted about the 10% interest rate cap, he then said he supports the Credit Card Competition Act, which does not have an interchange rate cap. It gets called an interchange measure. It does not actually have an interchange rate cap, but it would require large credit card issuers over 100 billion in assets to add a second unaffiliated network. And we had not seen President Trump weigh in on Credit Card Competition Act in the past. So that was another, I would say, probably surprise for some this week. And, I think the question is now is, what does that White House support mean in terms of possible movement for the Credit Card Competition Act? I wouldn't be surprised if there is a vote in the Senate on the Credit Card Competition Act. You've got bipartisan sponsors who have been pressing leadership to get a vote on this. This has been, a topic for a couple of congressional sessions now. You've got Senator Durbin as one of the lead sponsors. He's retiring at the end of the year. It would be very natural for him to want to push really hard to have, additional kind of legacy types of measures. So yeah, there is, I would say, some momentum around the Credit Card Competition Act because of President Trump's engagement now on it that we really didn't see in the last year on this topic.
Yeah. Wow.
Yeah, and then you think about, potentially the 10% cap on credit card interest rates, CCCA, and then layer in, again, I'm stealing Steve's thunder, but you layer in what Visa and MasterCard have proposed as a settlement with the merchants, and that's impact to credit card profitability. I know there's a lot of financial institutions out there listening and are wondering, okay, what's next with the Visa MasterCard settlement? I think it's up to one judge in the courts, right? It seems right now, and it could be, I think, later this year that he comes to a decision on that. What are you hearing about the Visa MasterCard settlement with the merchants?
Yeah, it's again, you're right. It is all related, big topics and payments. It's hard to predict court decisions, a little harder than probably some of the political stuff we're used to. But I will say this. Obviously, this is now year 21 of this class action lawsuit. It affects credit cards, not debit cards. But there have been previous attempts at settlements. And I think one of the driving challenges is that because it's a class action lawsuit, that means every merchant in the United States that has accepted Visa or MasterCard credit cards since the period of time the suit has been running, so 2005 till now, is affected. And think about that body of businesses. You've got the smallest businesses in the country and the largest businesses in the country. How to come up with a settlement that is going to satisfy that big of a spread of businesses across every industry, Like, I don't know how you ever really can do that well. And so I think that's been the challenge with the settlement is you've got this just master class of merchants that are very different, looking for different outcomes here. Probably, I would think some of the small merchants probably just want maybe some money back, but for some of the larger merchants who have publicly butted heads with the global networks over the years, they may want more than a check, right? They want legitimate changes in the way that those networks conduct business. And so I think that's hard to accomplish in a settlement. We did just see a change in the judge. So the previous judge who had been overseeing this case, who had thrown out the last settlement, is different. And so I don't know what that means. That might mean that this judge is more willing to accept the settlement on the table. But what we do know is there will be a hearing. Both sides will get to kind of say their piece. We already know that some of the large merchants are objecting, and the judge will take that under consideration. So really hard to say if this will be the year that the settlement stays. But I do think that if you look at just, and then I'll stop that, I think if you look at some of the components of the settlement, and again, the merchants are objecting to this, but it does, I think, try to address some of the pain points that merchants have raised over the years, like, for instance, honor all cards and honor all wallets. Now, practically speaking, the way you address that in reality, a little different. But, a new judge to this might say, well, hey, some of these major issues have been addressed. We're going to let it go forward. But I think it's really just really hard to predict this one, especially with a new judge.
Yeah.
Yeah, it is. I mean, for sure. But as you said, I think it certainly appears as if this proposed settlement has checked many, several more boxes than have been checked in the past. And most of those are on the side of merchant acceptance, or their, permitted flexibility to choose whether to accept or not, or charge surcharges or not at the point of sale. So, obviously they can argue whether that truly gives them something that they would enable and enforce, but it does check that box and kind of answer that question in my mind of the previous judge.
So I wanted to remind everybody in the chat function, if any of you have other questions for Kim or Leanne, go ahead and type those in the chat, and we can bring those up. But one kind of, I guess, final question, I guess, is in relationship to the interchange aspect of this, right? There have been some states that have actually tried to kind of take a lead here from specifically Illinois. Was like, all right, hey, we see the settlement thing, but we're going to take action on tips and tax. We're trying to remove that from that perspective of having interchange charged on that. Can you kind of talk through that law was enacted in 2025 in July? Other states are kind of looking at that. What are you hearing from some of the state rulings or state kind of proposals, if you will?
Yeah, I think, and Steve, I think, it dovetails with, frankly, what we just talked about with the settlement, which is, there has, I mean, let's just call it what it is. There has been a fight between, the networks and FIs on one side and merchants that accept cards on the other about the cost of acceptance. And so we're seeing, that fight has taken place in the legislative arena and as well as the judicial arena. And I think on the legislative side, right, while the Durbin Amendment capped debit interchange rates and changed some practices on debit, you still have a frustration on the credit side, hence the lawsuit that has continued to happen. And so I think, what we're seeing is some creativity again with different merchant segments who have now, gotten, I think, probably frustrated with inaction at the federal level and said, okay, well, you've got 50 state legislatures. Why don't we see, if we can get some relief on interchange through that way. So Illinois became the first state. They actually passed their law in 24, but the effective date was pushed out to 2026 this summer. But where, yes, the law says that you could not assess interchange rates on the sales tax or gratuity portion of any transaction, not just debit, credit, prepaid. but we haven't seen it implemented yet. And because Illinois passed this law, a bunch of other states have sought to do the same thing. We saw a bunch of introductions last year. We've already seen 12 states this year try to go down this path. So again, it's another variation of this effort to try to lower the cost of acceptance. I think it's tricky with this particular law because it's not like just the processors, the merchant acquirers can figure this out, or just the networks. You have to come up with a solution that's going to work for every merchant acquirer, PFAC, gateway, right?
Yep.
Every credit card and debit card network, and every issuing financial institution. Now, there's a lawsuit that's been filed. It could be that the way that the court comes down is to say federally chartered banks are preempted. But that would only solve the issue for federally
Yeah.
chartered banks, right? So if you're a processor like Fiserv is, or a network, you still could have this consortium of state chartered banks and credit unions that would be subject to this. So, it would still be some pretty big changes to the authorization flow. And so for that reason, the networks and financial institutions have fought this. We are in now another legislative session in Illinois. And so I do think what we're seeing is a little bit of a pause for some states to figure out what is the court case going to decide. And then depending on what happens with the court case, that could also change the lobbying effort this year in the Illinois legislature to where maybe the law is changed or even at some point overturned. So a lot still here, Steve. We
Yeah.
don't really know where
Yeah.
it's going to land. The court case in Illinois will, I think, drive a lot of that, though.
Yeah. I mean, you bring up an amazing point of just the the challenge in all of this regulation is that there are so many different parties in here, and
Yes.
it's large merchants, small merchants, retailers, infrastructure. No, I mean it is, and then getting everybody on the same page with that kind of a scenario and the implications for that are huge. And again, it's this wave that is just it just comes and goes, and understanding how to do that. So um haven't had any questions come through, but are there any things that you see on the horizon? I mean, we've talked about a lot, right, in this conversation. Anything to kind of add there that's just that you see that's like, hey, these things are coming from the lobby groups, from the different sessions within Congress that are on the horizon that you see that financial institutions should be keeping their eyes on as well?
Yeah, I have a couple thoughts. Keeping my eye on the time. I think I would say probably three things. One is um, I'm not seeing a real path forward for Congress to become less dysfunctional. Even it doesn't matter who is the party in power. We're seeing. I think we're going to continue to see these really slim majorities, and as unfortunately I think primaries make the parties more extreme, the real governing has to be done in the middle, and that is it's really hard to find consensus, really, again, under kind of any scenario of political party governance. And so I think even though, as we think about in financial services land, EFTA, the Electronic Funds Transfer Act, right, and
Yeah.
Truth in Lending Act, these 1970s laws that apply to debit and credit that really need to be updated and modernized, it's hard to imagine where Congress can actually come together and modernize any of these things. So we're like square peg, round hole, things like P2P payments and
Uh-huh.
stablecoin, although that now has law, but digital assets. And so I think that means that even though we're due for modernization, probably not going to see that happen at the federal level, which means we're going to continue to see pressure at the state level where consumer groups, financial institutions, merchants, processors, like we're all now, have this new battleground where states have shorter sessions, in some cases have term limits, can be really hard to get in and educate 50 state
Yep.
legislative bodies. So I think that's going to continue to be a pressure point. But then I would also say before we wrap, I think as financial institutions are obviously always thinking about how they grow deposits, you still have these areas in high risk that do seem like they are getting more and more traction and more comfort by the regulators. So cannabis, gaming,
Mm.
crypto, like those areas for sure, especially in this push at the federal level to not have debanking. I think that you're going to see the appetites change for a swath of probably more on the community bank and credit union side to say, this could be an attractive place for me to get deposits. Still have to have my compliance, still have to have my risk assessments. Like, it's you still have to put it in the banking regulatory apparatus. But I think those areas could be ripe for, potential new deposits and maybe even younger depositors, depending on the industry, for, community banks and credit unions to be looking at. So I wouldn't discount those traditionally like high risk areas either.
That's some great insight. Yeah. Leanne, any final thoughts from you?
I think just to balance out the focus on growth and deposits, certainly that is something we see in the advisory practice. However, most financial institutions are focused on that growth as sort of that low cost funding source for their loans. And right now, on the lending side, particularly for credit card, profitability there is under pressure from a variety of the items that we talked about, the Visa and MasterCard settlement, the 10% cap on interest rates for credit card, and just CCCA in general. So what we're seeing is financial institutions focus on, what does my portfolio look like today? My card portfolio look like today? Should it look like this in the future? Is it positioned for success should some of these factors actually unfold in a way that's not on the side of the financial institution? So I would say, to the banks and credit unions out there, if you're looking for a place to start, really start by assessing your payments revenue streams and evaluating the impacts to them and how that may impact your future go forward strategy.
Interesting. We did have one question come in. And so Kim, the Clarity Act, in relationship to, digital banking and crypto. So the question is, could the delay in the Clarity Act be a sign that banks are nervous about competing with digital bank and crypto that can offer higher interest rates? Curious on your thoughts regarding larger banks potentially having the ability to have the resources and funding to create that crypto while delaying in the act.
Good question. So Clarity Act, just for a quick level set for those who don't know, is also kind of referred to as the market structure bill. So last year, the Genius Act set up a regulatory framework for payment stablecoins, but there are a whole bunch of other types of digital assets, not stablecoins, Bitcoin being one of them, that haven't really cleanly fallen into a federal regulatory bucket. So this market structure bill, known as the Clarity Act in the House, attempts to say, okay, for all these other types of digital assets, when is it a security and regulated by the SEC? When is it a commodity and regulated by the CFTC? And then what would all the regulations be around that? So the crypto industry especially feels like, look, this is really necessary clarity for them to be able to continue offering different products and services and have those grow lawfully in the US, right? We all want that lawful piece there. So it's been a big priority for the crypto industry. But financial institution, the banking lobby, especially like the ABA, ICBA, that represents the large and small banks, have weighed in to say, we are worried about deposit flight. We are worried that as crypto grows, it could be at the expense of money in the checking accounts, right? And so there's been a big disagreement and political fight about, should you reward holders of digital assets and stable coins, and give them interest? Would that incentivize people to move money faster out of the banking industry? And banks are very worried about that. And so they've expressed that on Capitol Hill. And that is one reason that the hearing is not happening today with the Senate Banking Committee on the market structure bill, is this disagreement about, on the one hand, crypto enthusiasts want to incentivize crypto to grow. On the other, there is nervousness about what that means for the health of the banking industry. And I'm not really sure where it's going to land, Steve. Both of these now, crypto and banking, very influential set of lobbyists, lots of money being put into campaigns. And so I'm not quite sure where that lands. I think some more time is needed to work those out. But I think that you are seeing bipartisan support in Congress for crypto, as well as with the White House. But again, I think trying to figure out how you can grow crypto in a way that doesn't totally disadvantage the banks.
Yeah,
There are a lot of bank fans and credit union fans on Capitol Hill as well. So I think we need a little more time to see where this all lands.
great. Well, Kim, Leanne, thank you so much for joining. Appreciate the conversation. A lot of topics that we talked through. Hopefully, we shed some light on a few things for the institutions. And again, we appreciate people attending and engaging with us. And please reach out if you have further questions. Want to dive deeper? Happy to have follow-on conversations and move that forward. And happy to have Kim here as well. And thank you all for joining.
Thank so much.
Thank you.
Great talking with you.